I'd like to introduce the performance evaluation of our portfolio. According to the time series line of weekly return, our portfolio have two features. Firstly, relative large scale in upside return and small scale in downside return. For example, the portfolio has relative high positive return in week 4 and week 7, bigger than 0.2%, while the absolute value of portfolio downside return is all lower than 0.2%. Second, the magnitude of price change is really low. The value of our portfolio is almost constant. According to the result, the beta of our portfolio corresponding to S&P 500 market index is 0.01, which means we have successfully hedged the market risks. The return of our portfolio is 0.25%. As our factor are long-term of investing factors, so in such a short period, it's not easy to see a surge in our return. We also have two reward to volatility ratio, Sharpe ratio, and Torino ratio. The Sharpe ratio is positive but relatively low, and the Torino ratio is high. Study the difference between Sharpe ratio and Torino ratio could tell us our risk consists of what our risk consists of. Sharpe ratio evaluates how much excess return was generated from each unit of the whole risk taken by the portfolio, whereas Torino ratio evaluates how much excess return was generated from each unit of market risk taken by a portfolio. Thus, our market system risks have been well diversified, but the idiosyncratic risk of portfolio can be relatively high. We only have 20 stocks, so their idiosyncratic risk are not well diversified in the portfolio. We have two performance metrics to compare our portfolio performance with market benchmark. S&P 500 index, Jason, alpha, and information ratio. Unfortunately, they are all negative, which means our portfolio earn less than market portfolio. This is because the market performed well in the trading period, and by shorting ETF, we cannot get the market premium. We do not endure market risk either, and it's a fair game. Although we have positive return, the value of our portfolio does not increase as quickly as market benchmark, so we lost the match. But if the market is a bear market, we should overbeat market index, as we will also have a slow but low growth in bear market.